Good day. On behalf of Predico Software, we're going to discuss our Advanced Flow Analytics or AFA platform. In particular, we're going to look at RTA versus decline workflows and see how AFA can make things smarter, faster, and easier for you. Through a series of examples, we'll basically compare decline and rate change analysis forecasting, particularly in the presence of noisy or bad data, shut-ins, various operations, whether it be pump fixes, compression, stimulation, or just general missing and erroneous data. Before we get started, let's say we ran a group run on 46 wells using our Rule-On module. So Rule-On allows us to look at all the wells we have in our system, perform declines, rate trans analysis, FMB, whether it's a gas well, oil well, all in one shot. So we can perform multiple analysis on multiple wells with a single click. And in fact, 2 minutes runtime for 46 wells, including decline, RTA, and FMB. That's roughly 2.6 seconds per well. Good afternoon. We are going to look at some of the workflows associated with our group runs and automation. We originally did a group run of 45 wells, a combination of oil and gas wells, shale, tight gas, Permian, Triassic, etc. Begin with, let's take a look at our first well, Blue Bonnet A, and we're going to compare some of the workflows between RTA and oil decline. As obvious, we have field data that's been unaltered provided directly to us. And if we take a look at the analysis, we see it's done a decline line. However, this decline line is not really meant for this data. We see relative intermittent production. We see a relatively constant or increasing trend, both of which make decline very hard to apply. If we looked at the rate versus time plot, the problem becomes even a little more obvious. Now, a person then must override a lot of this analysis manually. This may be moving this line manually and seeing what it does. But we can see it has a huge long decline tail. This implies that this model probably is still unsuitable because it's unbounded. The erratic data has given us a trend which is basically unrealistic. We've done a forecast to the year 2040, but the decline line will probably go on for hundreds of years given this trend. What this means is we either have to manually adjust parameters such as the decline exponent or the initial decline rate, or even apply a modified hyperbolic and have a multi-segment decline based on outside information from this well. Overall, that's a fairly manual process. So let's put our automation back and let's take a look at what oil RTA might do for this well. As we'll see, we've got the same raw data. Nothing has changed there. We do have some basic user inputs, initial pressure, some gas, oil properties, etc. But here we find autoRTA has actually performed the analysis. It's put together an effective productivity model. There's no human intervention required, and it generates a forecast based on that data or that analysis. Now I'm turning flowing pressures off, but you can see the autoRTA model actually tries to capture the variable rate data, then generate a forecast going into the future based on the physical parameters from the analysis. Now, just as an example to demonstrate the ease of this, we're going to assume we have the wrong horizontal length. So let's say it's actually 10,000 feet as opposed to 14,000 feet. We'll update the analysis automatically. It does a history match. It does a forecast. And we'll see that we have a great match still. So it's generated, it's tried to follow the production, it's tried to actually honor flowing pressures and rates, built the reservoir model, and done a forecast. What this shows is with ugly and abhorrent data, autoRTA actually handles a lot of it quite well, given that if you import tubing pressures or pump intake pressures and correct them for the bottom hole depth. Hello, we're going to look at another Permian well within our group run of 44 wells. This time we're going to focus on oil boots 14. Let's take a look at our oil decline. We got oil, water, gas rates, and intermittent, average, not great pressures, but the pressures to work with. We see our automated decline. Now, there's a lot of scatter here in this data. We'll zoom in. A big chunk of it appears as well as shut in for a while. Transient rates come back in, shut in, and so on. If not, and if actually rates are tending to flatten out towards the end. This means that perhaps decline line is not best meant for this data. Maybe there's something going on, operational changes which don't apply. And like before, someone has to do a manual override and try to decide what the best decline would be. So I'll put some lines here, zoom out. Now, we also, of course, have to adjust the late time. If we look at the rate versus time plot, we can start to see that possibly due to low rates, 14 to 20 barrels a day, whatever is in that range, that maybe the decline doesn't have that much of an impact, given that this well is heavily depleted. But still, you could end up with a very long tail. Ultimately, with manual overrides, where there's an operational profile forecast, someone has to adjust the B values, initial decline rate, and even maybe put in a modified hyperbolic or some sort of manual multi-segment. Of course, multi-segment and manual or modified hyperbolic do require knowledge from offset wells to give you ideas what to do in the future. So let's take a look at oil RTA. Same raw data. We do have some basic inputs, pressures, some basic petrophysical parameters. A fully automated analysis, as we saw in the previous example or examples, we could change inputs and just hit SmartFit and let it calculate. It comes up with a basic productivity model. Forecast is fully automated again, unless we change something. Now I'm going to turn some of these flowing pressures off. One of the advantages of RTA is it tends to honor the whole entire production history, giving you more faith in the basic reservoir model it's put together. As you can see here, AFA tries to honor the shut-in periods all on its own and then do the forecast going forward using the base reservoir model. If we were to take a look at the cumulative oil chart, we can see even here, this is another way of looking at how well the history match has been accomplished, all using automation. Now, this well tends to have some high line pressures towards the end. 243 psi, which is a fair amount of liquid above the wellbore or above the producing zone. We could see what would happen both from a production and economic perspective with our economics tab. Currently, if we just leave things as is, we have our basic operating costs in here. We don't have any capex going forward. We get an economic value of approximately $312,000 after OPEX. You can see our cash flow, etc. But what if I could bring that pressure down a bit? So we can actually do a little bit of sensitivity analysis here. We know the reservoir model already. We're just changing our forecast pressure to see what would happen. And we see a bit of a rate change. Now we've dropped the pressure. Maybe it's because of better pump, maybe because we did some sort of major intervention. But we can also see, is that justifiable with our current economic parameters, right? We're getting above maybe 80, 90 barrels there, depending what the resolution is on the screen. So let's say we did some sort of intervention and roughly cost us $300,000. Let's hit calculate economics. We see when our intervention went down to bring that flowing pressure lower, our cash flow went a bit negative for a short period and it recovered. We see our economic value went from 312 to 529,000. So great. Depending on your economic outlook, this might be a very good rate of return. It has 176% return on investment, so that sounds pretty good. This is the advantage of using our software. It's fully automated, again, from the analysis to the forecast, even to the economics. Hello. In our third example, we're going to look at a well called Death Valley E. And we'll start off with decline as usual, and we see our production data, rates and pressures, and we see an analysis. Now if we zoom in a bit here, we do see rates sort of flattening out halfway, a fair amount of scatter here and decline again. The model is put together in exponential decline, which you may or may not believe. More importantly, if we look at the late time data, we see this well has been shut in for approximately a year. And assuming the same operating conditions, decline says this well, if it came back on, would produce roughly 10 barrels a day, maybe 9 to 11 as a sensitivity. However, decline is not meant for making predictions post shut-in or predictions including compression for gas, intervention for oil wells, etc. So let's take a look at oil RTA and see what happened. Oil RTA, same raw data. Input grid, petrophysical parameters, initial pressure, etc. Automated analysis for minimum original oil in place, productivity parameters, etc. And automated forecast. We will turn some of these flowing pressures off and zoom in on the late time data. Actually, we'll zoom in on the shut-in period post shut-in. So, assuming all the operational conditions stay the same, RTA is saying this thing will produce up to 100 barrels a day initially. That's 10 times greater than decline suggested. And that's because RTA accounts for pressure buildup in the near wellbore region while the well is shut in. So as we said before, decline models don't handle shut-in periods very well. They don't handle a lot of the operational changes that might happen in the future. And to sort of mimic some of this, you'd be purely guessing with decline. Now let's take a look at some other features of our software here in terms of workflow. We do have an economics tab as discussed before. And if everything stays as is, our variable OPEX, oil and price costs, and things like that. And we can see now that we have an NPV of $145,000 after the OPEX. But let's say we actually did do some sort of intervention. We just didn't have the same operating conditions, but we actually changed something. So I'm going to bring this line pressure down to 100 psi. Now this may be a reduction in liquid level, faster pumps, change tubing, etc. We'll look at our rates and see we're now in the 200, nearly 300 barrels a day range. Now, of course, if we do economics, we do have to include a CapEx. So I'm going to say this roughly cost us $300,000 for whatever they did. We update our economics, and we see our net present value is actually decreased. Although we're getting more rate, the amount of cost for that rate was not justifiable. The return on investment is only 35%. The advantage of having RTA with economics is we can quickly evaluate the impact of these operational changes or intervention. Again, with decline, all of this is purely speculative, if not guesswork. In our final example, we're going to show that the same concepts we saw for oil can also apply to gas wells. So in this example, we're going to look at a horizontal well completed in shale gas. So in this example, let's start off with gas shale well number 9. Let's take a look at gas decline. Lots of data, just like the other wells, but let's take a close look at the rates. As we can see here when I zoom in, we see a bit of a decline, we see a relatively flat period, then a big shut-in period, and almost perfectly flat rates towards the end. So we already know that decline is going to give us some problems. Here's the automated analysis, flat rates, decline lines are both wrong. And it's no fault of the software, it's just that this model is not intended for this data set. So I must manually override, put some curves out into space, and hope for the best. This really isn't a good way of doing things. This outer region is not bounded by any physical data. It's not data driven, no physics model, etc. It's pure guesswork. This well obviously has had some sort of changes, either operational or in terms of recompletion or something, and the decline line just doesn't handle it. If you look at the rate versus time plot, we could see it even a little more exaggerated. Well, let's take a look at gas autoRTA. So similar to oil wells in the Permian, we have the raw data, we have some inputs, pressures, some basic petrophysical parameters, and we have a full-blown automated analysis. This is a 14,550 foot lateral, and this analysis is transient analysis. It's got normalized pressure, normalized rate, and of course the forecast is fully automated. So let's take off some of these information and do a quick zoom in. The RTA model has mimicked the transient spikes, has caught the shut-ins, it has almost perfectly caught the late time pressure data or rate data, and will provide a far more reliable number than anything a decline would produce. We have a productivity model that's been built. We have a connected amount of gas in place. It's bounded by physics and will not over extrapolate or run indefinitely in the future the same way decline models can. This has been fully automated and took only 2 or 3 seconds to actually do the analysis. Thank you for your time. In our concluding remarks, we're going to talk about an interesting observation. If we're to go through wells one by one and compare RTA and decline, you could argue that all our test cases, 70% of the wells, are better suited for RTA than decline or related methods. This is basically because decline does not handle bad data issues, noise, ugly data, past or even future operational issues. Or in the simplest case, they often produce unrealistic declines because it's an unbounded solution. Summary, decline ratio methods are very susceptible to errors in the presence of ugly data, non-idealized data. We all know that RTA and FMB are powerful methods to handle flow regime identification and produce highly accurate forecasts, but they tend to be very time-consuming and manually intensive. AFA has automated not only decline, but RTA and FMB, and this allows for very fast interpretation, something that's typically very complex, giving us smarter, faster, and easier production forecasts. Thank you very much.